A cryptocurrency is a type of digital currency that is maintained by a decentralized blockchain. Currencies are a part of the monetary system, and money is a system of transferring value between parties, especially for the purpose of trade. But what exactly is value? Value is a shared belief. If you think about it, there's no such thing as inherent value. Sure, something like a natural resource arguably has value that's usually tied to its utility, how useful it is. But regardless, the concept of value is an entirely human creation. People want things for all sorts of reasons. Money is simply a tool to exchange value. It is accepted as payment because everyone shares the belief that it has value. In this sense, what we actually use as a unit of account for money is less relevant. Basically, any object could be used as money. In some cultures, even rocks and seashells were used as money in the past. Today, inmates may use cigarettes or coffee as money in prisons. Money has value because our society believes it has value. Of course, some objects are more suitable for this than others. For example, gold was used as money before the creation of paper money. It worked well because it's scarce and durable, but it's also heavy, and it can be difficult to transport and divide, so it became inconvenient for everyday use. Then, coins and paper money were created to represent a fixed amount of a physical commodity, like gold, in a system called the gold standard. The gold standard solved the problem of portability and divisibility for bricks of gold. Today, coins and paper notes only account for a small fraction of the monetary system. Most of the money in the world is digital money, recorded in the ledgers of banks and other financial institutions. No economy uses the gold standard anymore, although most countries do keep some gold reserves. That's where fiat money comes in. Fiat money is legal tender that isn't backed by a physical commodity, and derives its value from the trustworthiness of its issuer, usually a state through its central bank. While the value of fiat money is influenced by supply and demand, the state backing it has a much higher impact on its value. If the backing state becomes unstable, the fiat money may also lose its value. It's simply a piece of paper that has value because the state says it has value. That's what the word fiat means, by decree. So the strength of the issuing state is key when it comes to fiat money. What's more, since it isn't backed by anything tangible, the state can theoretically print as much as it wants. Printing money causes inflation. Finally, let's turn to cryptocurrencies, which work very differently compared to fiat currency. They are digital currencies in which transactions are verified and records maintained by blockchain technology using cryptography, rather than by centralized authorities. This is what sets cryptocurrencies apart from the digital currencies in PayPal and other digital banking apps that are operated by centralized organizations. A good cryptocurrency will be decentralized, meaning it has no owner, and no one person or entity has control over it. While governments can unilaterally change the underlying rules of fiat money, cryptocurrencies should theoretically maintain an even playing field and consistent sets of rules. The unique properties of cryptocurrencies also make tracking users tied to their identities considerably more difficult, though not impossible, than through digital fiat money. Individual units of a cryptocurrency can't be duplicated or forged, and as cryptocurrencies exist entirely in the digital realm, they're highly suitable for worldwide transactions. Another core property of a good cryptocurrency is that the transactions happening on the blockchain are censorship-resistant and immutable. In the next module, we will look into the first cryptocurrency, Bitcoin, in greater detail. Bitcoin is the first cryptocurrency with very unique properties. It's a decentralized digital currency that you can buy, sell, and exchange directly without an intermediary, like a bank. While Bitcoin wasn't the first attempt at digital money, it's the implementation that has worked with the most success so far. Bitcoin was launched in 2009 by its pseudonymous creator using the name Satoshi Nakamoto. A year earlier, in 2008, Satoshi published the 9-page Bitcoin white paper and later released the original software as open source code. In the white paper, Satoshi described the need for an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties to transact directly with each other without the need for a trusted third party. Since then, many other cryptocurrencies have sprung up. But as of 2022, Bitcoin remains the largest cryptocurrency as measured by total value on the network. Before we get into more details of Bitcoin, you're probably wondering, what is the relationship between Bitcoin and blockchain? Blockchain is a distributed database where chunks of data are bundled together into blocks. These blocks are then chained together to create the blockchain. As a database, blockchain technology has many use cases, and Bitcoin is but one application of blockchain technology. How is Bitcoin different from fiat money then? Fiat money is centralized, controlled by a government or central bank, has an unlimited supply, and transactions are largely censorable, meaning bank accounts can be frozen or transactions can be inhibited. With most central banks around the world planning to move their fiat money system to completely digital systems, it'll undoubtedly become even more censorable in the future. However, physical cash still remains a private and anonymous way of transacting in the fiat system for now. On the other hand, Bitcoin is decentralized, peer-to-peer, and censorship-resistant. It's not backed by the government or any institution. Every Bitcoin transaction that's ever been mined exists on a public ledger, accessible to everyone. Moreover, Bitcoin has a limited supply of 21 million coins. These Bitcoins are expected to be mined by the year 2140. Cryptocurrency mining refers to the process of verifying and validating blockchain transactions. It's also the process that creates new units of cryptocurrencies. Now you can see that Bitcoin has some unique features, but how is it useful? People have been using Bitcoin, which has been nicknamed digital gold, as an alternative investment to diversify their portfolio and to make purchases and payments. Bitcoin is especially appealing for international remittance. On May 22, 2010, a Bitcoin enthusiast spent 10,000 Bitcoin to buy 2 large pizzas. Back then, 10,000 Bitcoin was worth around $40. Today, it would be worth hundreds of millions of dollars. That day, when the first real-world Bitcoin transaction took place on May 22nd, is celebrated as Bitcoin Pizza Day. As of mid-2022, over 80 million unique Bitcoin wallets have been created. And there are more than 270,000 confirmed Bitcoin transactions recorded on the Bitcoin blockchain daily. The fees and transaction times of Bitcoin are negligible compared to the traditional financial system. This is especially useful for large transactions. For example, in 2019, a transaction that was then worth about $1 billion cost the sender only about $650 to send. Bitcoin also has limitations. For example, during times of increased network activity, transactions may take some time to get through. The Bitcoin network also requires expensive equipment and lots of energy to mine. Despite these limitations, Bitcoin remains one of the most disruptive implementations of blockchain technology. Besides Bitcoin, there are many other different types of cryptocurrencies out there. We'll introduce some of them in the next module. You've probably heard about Bitcoin, Ethereum, and some other cryptocurrencies. We said before that cryptocurrencies are digital currencies. So, are all digital currencies cryptocurrencies? The answer is no. For example, many central banks are working on creating their own versions of digital currency, collectively referred to as central bank digital currencies or CBDCs. However, these are essentially digital versions of fiat money, and they don't enjoy most of the benefits of cryptocurrencies. They are issued and declared legal tender by a central government and typically don't use a distributed ledger, such as a blockchain, to keep a record of transactions. Since the first Bitcoin mining reward was received in 2009, the world of cryptocurrencies has grown significantly. On the broadest level, all cryptocurrencies can be broken into 2 groups, Bitcoin and altcoins. Well, yes, Bitcoin and not Bitcoin doesn't seem like much of a categorization, but this is because of how dominant Bitcoin is in crypto. The market capitalization of Bitcoin is a significant portion of the total crypto market cap, so people generally call all cryptocurrencies other than Bitcoin altcoins. Altcoin is a combination of the 2 words alternative and coin. There are thousands of altcoins in the markets as of mid-2022, with each one aiming to serve a different purpose or market. Next, you may have noticed that the terms coin and token seem to be used interchangeably sometimes. But are coins and tokens the same thing? At first glance, coins and tokens appear similar. Both exist on blockchains, can be traded on exchanges, and sent between crypto wallets. But the biggest difference is that coins are the native asset of a blockchain, such as Bitcoin on the Bitcoin network, Ether on the Ethereum network, and BNB on the BNB chain, whereas tokens are built on top of existing blockchains. For example, there are many tokens built based on the popular ERC20 token standard, but there is only one native coin, Ether, on the Ethereum network. Moreover, tokens can be used like cryptocurrencies, but they're more flexible. They can serve as anything from digital receipts representing a stake in a company to loyalty points. Therefore, tokens can be categorized into different types according to their function and purpose. For example, transactional tokens serve as units of account and are used to exchange goods and services. Governance tokens give token holders the right to vote on governance issues of a protocol. Utility tokens are used as a form of payment within a specific ecosystem. There are also security tokens, equity tokens, liquidity provider tokens, and new types of tokens are likely to be created in the future as the crypto industry continues to innovate. When it comes to tokens, you can also mint millions of identical ones or mint a select few with unique properties. You've probably heard about non-fungible tokens or NFTs. NFTs are cryptographic assets on a blockchain with unique identification codes and metadata that distinguish each token from another. Non-fungible means items are not interchangeable because each has unique properties. This is a key difference between NFTs and other coins and tokens that are fungible. Being fungible means the coins and tokens are identical to each other, and therefore can serve as a medium for commercial transactions. Bitcoin and Ether are fungible coins, for example. There are many more types of cryptocurrencies, but we can't cover them all in this module. A good place to start is to familiarize yourself with the biggest cryptos in terms of market capitalization first. From there, you can gradually explore the less mainstream altcoins. In the next module, let's look into centralized and decentralized crypto exchanges where you can buy and sell cryptocurrencies. There are many ways to buy cryptocurrencies. The first thing you'll need to do is convert your fiat currency into a cryptocurrency. Then you can choose to either hold it, trade it for other cryptocurrencies, or lend it and earn interest. By the way, you can learn more about it in Binance Academy's crypto trading courses, so don't forget to check that out. For this module, we will take a look at the two main types of cryptocurrency exchanges, centralized exchanges and decentralized exchanges. You might find the concept of a centralized exchange a bit confusing, since cryptocurrencies are often referred to as decentralized. The idea of centralized crypto exchanges refers to the use of a middleman to help conduct transactions. Buyers and sellers trust this third party to handle their assets. So the way the exchanges work is centralized and requires trust in a third party. In centralized exchanges, users deposit their fiat money or cryptocurrency to the exchange and trade within its internal systems. Users' crypto is held in custody by the exchange, but it should be fairly easy to withdraw funds and keep them in your own wallet if you want to. The centralized exchanges operate as a middleman to facilitate the completion of transactions. The best centralized crypto exchanges provide a high level of security to users. For example, because cryptocurrencies are often stored in digital wallets, users can lose their money if they forget their keys. A centralized exchange won't let this happen, as it safeguards the holdings on behalf of users. Moreover, centralized exchanges generally will ensure the safe completion of transactions. Because of this convenience and security, some users might prefer keeping their funds on centralized exchanges, particularly if they trade regularly or are new to crypto. But there are some risks to centralized exchanges. They can be hacked, or the operating entity could face financial difficulties. In both cases, user funds might be at risk. On the other hand, decentralized exchanges operate very differently. There are no custodians involved in decentralized exchanges. In fact, we can refer to decentralized exchanges as non-custodial exchanges. They cut out the middleman and operate in a trustless environment. You can also think of them as peer-to-peer exchanges, where transactions are done between users directly and entirely based on smart contracts, which are self-executing computer programs on a blockchain that run when predetermined conditions are met. Here's what happens when you trade on a decentralized exchange. Instead of depositing your funds to the exchange's wallet, you're trading directly from your own wallet. When a trade is executed, the transaction is completed directly on the blockchain using smart contracts. Since there's no entity acting as a custodian, some consider decentralized exchanges a better choice than centralized exchanges. Another upside is that most decentralized exchanges don't require you to provide any personal information other than a blockchain wallet address, offering a higher degree of privacy. But using decentralized exchanges requires taking custody of your own funds and usually a decent amount of technical expertise. You're also entirely responsible for all your funds and actions. While you can call customer service when you run into any problems when using a good centralized exchange, there is zero customer support when using decentralized exchanges. For those who are new to crypto, it's generally considered preferable to begin the crypto journey with a reputable centralized exchange. As you gain more experience and expertise, you should explore a wide range of centralized and decentralized exchanges to find the exchanges that best suit your needs. In the next module, we will get into the subject of crypto wallets and how you can use them. Whether you are a frequent trader or a buy and hold investor, you'll need a wallet to trade crypto. A crypto wallet is a tool that you can use to interact with a blockchain network. Contrary to popular belief, crypto wallets don't truly store digital assets. Instead, they provide the tools required to interact with a blockchain. In other words, these wallets can generate the necessary information to send and receive cryptocurrency via blockchain transactions. Such information includes, but is not limited to, one or more pairs of public and private keys. You may recall from our Blockchain Fundamentals course that public and private keys allow you to send and receive crypto without requiring a third party to verify the transactions. Your crypto wallet also generates an address, which is an alphanumeric identifier that is created based on the public and private keys. In essence, such an address is a specific location on the blockchain records to which tokens can be sent. This means you can share your wallet address with others to receive funds, but you should never disclose your private key to anyone. The private key gives access to your crypto, regardless of which wallet you use. Even if your computer gets compromised, you can still access your funds on another device as long as you have the private key. There are many types of crypto wallets. Depending on their working mechanisms, they can be categorized as hot or cold wallets. A hot wallet is any wallet that is connected to the internet. For example, when you create an account on a centralized crypto exchange and send funds to the wallets, you are depositing into the exchange's hot wallets. These wallets are easy to set up, generally requiring no more than downloading software and creating an account. The funds are quickly accessible, making them convenient for new users and frequent traders. Cold wallets, on the other hand, have no connection to the internet. Instead, they use a physical medium to store the keys offline, making them resistant to online hacking attempts. Cold wallets tend to be much safer for storing your coins and are particularly suitable for buy and hold investors. Another way to categorize wallets is to break them into software and hardware wallets. Most software wallets are hot wallets and can be further broken down into web wallets, desktop wallets, and mobile wallets, depending on where you access them. Hardware wallets are physical, electronic devices that use a random number generator to generate public and private keys. The keys are then stored in the device itself, which isn't connected to the internet. As such, hardware storage constitutes a type of cold wallet and is deemed as one of the most secure wallets, but they require some expertise and are less user-friendly. You should consider using a hardware wallet if you plan to hold your crypto for a long time, or if you're holding large amounts of crypto. With so many types of crypto wallets available, which one should you use? There is no definite answer. If you are a frequent trader, using a web wallet allows you to quickly access your funds and trade conveniently. However, if you like to buy and hold a large quantity of crypto, cold wallets may be better alternatives. No matter which crypto wallets you use, you should always keep the security of your crypto as your top priority. If you lose your private key, you lose access to your funds. If someone else obtains your key, they can spend those funds. Keeping your private key away from prying eyes, but in a way that you will not forget, is of paramount importance, as losing your crypto is permanent in the vast majority of cases. In this Trading Basics course, we will learn the fundamental concepts of trading in 5 modules. By the end of this course, you should be able to tell the difference between trading and investing, understand technical and fundamental analysis, and grasp the concepts of financial markets and market cycles. In this first module, we will discuss what is trading and investing. So, what is trading? If you've been involved in financial markets, you've likely got an idea of what trading is. The term can bring to mind hectic stock trading like you might have seen in the movies, but what's the technical definition of trading? An essential part of economics, trading refers to the buying and selling of assets. Whether you're purchasing groceries, swapping euros for dollars, or buying Tesla stock, you're making a trade. Any activity where you give something to someone in return for something else is a trade. When it comes to financial markets, we typically talk about trading financial assets like stocks, bonds, forex pairs, options, and cryptocurrencies, among others. Each trader adopts a different strategy according to their risk profile and tolerance. For example, day trading is one of the most common strategies, in which a trader buys and sells financial assets within the same trading day. Another option is swing trading, in which trading positions are open for a few days or weeks. Then, what is investing? Trading and investing are commonly confused concepts, so what exactly is the difference between the two? The aim of both these activities is similar, but they're somewhat different in their methodologies. When you invest in something, you hope to get a return on that investment. This means you'll get back the money you put in, plus extra. You could invest in a small business, house, or financial asset with a plan to sell it later at a profit. If you invest well, you might even be able to double or triple your initial capital. While a trader also wants to make a return, they do this over a much shorter period. So while a trader might buy the same cryptocurrency as an investor, traders are looking to make gains from short or mid-term price changes. Traders frequently enter and exit positions to generate smaller returns over many trades. In contrast, investors play the long-term game. So, how do investors and traders decide what to buy and sell? Typically, investors and traders perform analysis before risking their money. The analysis frameworks they use can be broken down broadly into two categories: fundamental analysis and technical analysis. Investors and traders perform analysis before risking their money. The analysis frameworks can be broken down broadly into two categories: fundamental analysis and technical analysis. Fundamental analysis tries to identify an asset's intrinsic value. This is achieved by looking at economic and financial factors in an attempt to find the fair value of an asset. You may look at macroeconomic factors like the global economy or an industry's state. Microeconomic factors can also be important if you're investing in a business or an asset related to a business. The end goal is to establish whether an investment is undervalued or overvalued by the market price. Let's look at an example. Imagine you purchase a hypothetical cryptocurrency called Cryptocurrency A. You buy Cryptocurrency A for $10, but your research into the project and founders suggests its real value should be $20. You may then decide to invest more in Cryptocurrency A in anticipation of it realizing its fair value. When it comes to cryptocurrencies, there are specific fundamental analysis techniques you can implement. On-chain metrics look at raw data available on public blockchains. These figures include a token or coin's network hash rate, distribution, number of active wallet addresses, and other transaction metrics. With this combined information, fundamental analysis can create indicators to help inform investors' investment decisions. Fundamental analysis has been popularly used in stock markets, but applying these techniques is relatively new in the crypto world. There isn't a standardized, comprehensive framework established yet. The methods can vary greatly from one investor to another. You should also note that crypto markets are largely driven by market sentiment and narratives. Depending on the context, fundamental factors can have negligible effects on a cryptocurrency's price compared to fear or greed in the market. In other words, market sentiment may cause prices to change in unexpected ways that don't match the conclusions of fundamental analysis. Next, what is technical analysis? Technical analysis uses previous price and market data to try to identify price patterns and predict future price movements. Unlike fundamental analysis, technical analysis isn't concerned with an asset's underlying or intrinsic value. Instead, technical analysts study price changes, trading volume, chart patterns, technical indicators, and other charting tools to forecast future price moves and trade on these predictions. In short, we can say that technical analysis disregards news and other fundamental factors and is mainly focused on market charts. Technical analysis applies to any financial market and is very popular among cryptocurrency traders. But is it actually effective? To some specialists, technical analysis creates a self-fulfilling prophecy. Technical analysts make market predictions using the same techniques and indicators. If enough traders and analysts also believe the same predictions, this can change trading behavior and confirm the predictions. This potential effect means that technical analysis can be effective sometimes and unreliable in other situations. On the other hand, technical analysis supporters argue there's a large range of opinions and analysis methods. This means that the chances of a large group of traders making the same analysis and behaving similarly is very low. Another argument in favor of technical analysis in the crypto industry is its reliance on price data. Some argue that many crypto traders are not interested so much in the fundamentals of a project, but are mostly driven by price predictions. This makes technical analysis more suitable. Others have argued for crypto investors to focus more on the fundamentals. Of course, fundamental and technical analysis are useful in distinct ways. How should they be applied to crypto trading and investing? That's what we will explore in the next module. We have learned fundamental and technical analysis, and you might wonder which is the best to use for you. The answer is each methodology has a different approach that can be suitable at different times. For example, it makes sense to use fundamental analysis if you want to invest and forget over a long period, as technical analysis requires you to regularly check the markets and trade frequently. Fundamental analysis is especially useful with less volatile assets that derive their value mainly from a business or product. Stocks are a good example of this. It's simple to see that the performance of Apple stocks depends on the company's products and their success. You might want to use fundamental analysis to invest in stocks over a long period of time, which is a lower risk method of investing. However, if you're looking to make gains over the short term, technical analysis might be a more suitable analysis framework. Short-term price movements can be more effectively explained via technical analysis. This is because traders make a call on whether an asset's price will increase or decrease based on previous price action and technical indicators. Short-term trading relies mainly on trading charts and not on the asset's fundamental value. It's also important to understand that traders and investors don't just have to stick with one type of analysis. It's common for the two to be combined, especially among crypto traders and investors. Let's look at an example. Alice has conducted fundamental analysis on Ethereum and found that its planned future improvements are likely to significantly drive up demand for the network services over the next several years. It will likely lead to significant upside for Ether price. But due to market sentiment, Ether's price has been bearish and dropping consistently. Alice believes that Ether is oversold and buying Ether would prove to be profitable long-term. However, her technical analysis suggests that Ether price is likely to continue to drop. Alice waits until Ether price drops to a level that her technical analysis points to as a bottom. Alice then purchases Ether and plans to hold until she can realize Ether's long-term price appreciation. As you can see from this example, Alice has a higher chance to maximize her returns by combining both fundamental and technical analysis. But you must remember that past price performance is no guarantee of future results, and fundamentals can't always explain price movements. This principle of combining multiple analysis methods is called confluence, allowing traders to create a single strategy with the benefits of them all. Trading opportunities presented by the combined strategies could prove more robust than ones from a single strategy. Your trading style will ultimately dictate the mix you use and will depend on your risk profile and trading time frame. It's also important to understand market trends and cycles when you invest and trade. In order to be successful in trading and investing, you need to understand financial markets, market trends, and cycles. Let's dive into exactly what they are. A market is simply where buyers and sellers meet to trade. Going to the grocery store to buy apples is an example of a market. The price you pay for something in a market is dependent on the balance of supply from sellers and demand from buyers. If the grocery store is struggling to supply apples, but consumers want to purchase lots of them, the price will increase. If there is no demand for apples but a huge supply, the price will decrease. Anywhere supply meets demand, a market exists. Financial markets take the same concepts as our grocery store example, but instead they deal with financial assets. Supply and demand create the market and determine prices, but what exactly makes up the levels of demand and supply in a market? The amount of assets supplied for sale in a financial market has many reasons behind it. For example, the supply of gold can be affected by the amount mined, production costs, and import taxes and tariffs, among other things. The overall demand in a market like gold can be affected by the state of the global economy, returns on alternative investments, and other factors. Many see gold as a place to store money when there are economic problems or in an emergency. If financial markets are down and we are perhaps entering a recession, some people like to invest in gold as a safe haven, causing the demand to increase. Whether we are talking about apples in a grocery store, gold on financial markets, or cryptocurrencies, the principles of demand and supply are always the same. The only difference will be what affects supply and demand in each financial market. There are two main types of market trends: bullish trends and bearish trends. A bullish trend would be a noticeable increase over a period in the market price of an asset. A bearish trend is a noticeable decrease in an asset's price over a period. Market prices can also move sideways, otherwise known as consolidating. In this case, there's no clear directional trend. As these trends continue, we can describe a market as being bullish or bearish. If there has been a string of bullish trends in a row, we can probably say that we're in a bull market. The same goes for a period of continued bearish trends. In this case, we could assume that we're in a bear market. However, a bull market doesn't have to be one long, continuous, and constant rise in price. Sometimes a bull market will have some smaller bearish trends in it. The same goes for bear markets too, as they can also have some bullish trends in them. In fact, we only get the full picture much later, and we can only determine markets and trends with certainty and hindsight. Lastly, you may have heard that the market moves in cycles with repeating trends. Almost every asset will experience cycles between bullish and bearish markets. Long-term market cycles are more reliable than short-term market trends and can be easily seen on graphs with decades of data. If you take a look at the stock market's performance or crypto markets over the past few years, you'll easily be able to identify the market cycles. Shorter cycles will appear as you zoom in on shorter time periods. As with market trends, it's challenging to determine what stage of a cycle we're in and when a new one will begin. Understanding market trends and cycles is critical to be successful in trading and investing, but getting to know how market psychology impacts market trends is equally critical. We will learn what market psychology is in the next module. In this module, we will learn what is market psychology and how that affects market cycles. Market psychology is the idea that the movements of a market reflect, or are influenced by, the emotional state of its participants. It's one of the main topics of behavioral economics, an interdisciplinary field that studies the various factors that precede economic decisions. Many believe that emotions are the main driving force behind the shifts of financial markets, and that the overall fluctuating investor sentiment is what creates the so-called psychological market cycles. Market sentiment is the overall feeling that investors and traders have regarding the price action of an asset. The sentiment is made up of the individual views and feelings of all traders and investors within a financial market. You can also think of it as an average of the overall feeling of the market participants. But, just as with any group, no single opinion is completely dominant. Based on market psychology theories, an asset's price tends to change consistently in response to the overall market sentiment, which is also dynamic. How do emotions change during market cycles? All markets go through cycles of expansion and contraction. When a market is in an expansion phase, or a bull market, there is a climate of optimism, belief, and greed. Typically, these are the main emotions that lead to a strong buying activity. It's quite common to see a sort of cyclical or retroactive effect during market cycles. For example, the sentiment gets more positive as the prices go up, which then causes the sentiment to get even more positive, driving the market even higher. When the market starts to turn the other way, the euphoric mood can quickly turn into complacency, as many traders refuse to believe that the uptrend is over. As prices continue to decline, the market sentiment quickly moves to the negative side. It often includes feelings of anxiety, denial, and panic. How do traders and investors use market psychology? Assuming that the theory of market psychology is valid, understanding it may help a trader to enter and exit positions at more favorable times. The general attitude of the market is counterproductive. The moment of highest financial opportunity for a buyer usually comes when most people are hopeless and the market is very low. In contrast, the moment of highest financial risk often arises when the majority of the market participants are euphoric and overconfident. Thus, some traders and investors try to read the sentiment of a market to spot the different stages of its psychological cycles. Ideally, they would use this information to buy when there is panic and sell when there is greed. In practice, though, recognizing these optimal points is rarely an easy task. What might seem like the bottom may fail to hold, leading to even lower bottoms. Psychology has an impact on market prices and cycles, and the psychological market cycles are well known, but they're not always easy to read. From the Dutch tulip mania in the 1600s to the dot-com bubble in the 90s, even skilled traders have struggled to separate their own emotions from the overall market sentiment. Investors face the difficult task of understanding not only the market psychology, but also their own psychology and how that is affecting their decision-making process. Now, you've hopefully got a grasp of the basic concepts of trading and investing. Let's dive deeper into the different ways you can trade. We'll begin this course with the first module on portfolio and risk management. So, what is portfolio management? Your portfolio is a collection of assets and investments. Just like you can strategically manage your individual investments, you can also strategically manage your portfolio as a whole. A portfolio can contain real estate, stocks, cryptocurrencies, and even trading cards. Anything you invest in can be part of your portfolio. If you're only trading cryptocurrencies, it will likely be made up of a combination of Bitcoin and other altcoins. Each part of your portfolio can work together and contribute to an overall strategy. The first step to good portfolio management is setting your expectations. Are you risk-averse and looking for a basket of investments protected from high volatility? Or do you want something riskier with potentially higher returns in the short term? There are endless possibilities of how to put together your portfolio. It can be as complex or simple as you want, but it's recommended that you do some research and put in some thought. The amount of time you want to stay invested also matters. You could take a passive, hands-off strategy and leave your investments alone after you set them up. On the other hand, you can take an active approach, continuously buying and selling assets to profit. The key to determining your portfolio strategy lies in how you want to manage your risk. There are many kinds of risks you might encounter while investing and trading. The first is market risk, the potential loss you experience if the asset loses value. The second is liquidity risk. This occurs in illiquid markets, where you cannot easily find buyers for your assets. This can also cause potential losses if you cannot sell at the price you want. Next is operational risk, where potential losses stem from operational failures such as human error, hardware or software failure, or intentional fraudulent conduct. Finally, we have systemic risk, including possible losses caused by the collapse of an entire industry, market, or financial system. One example would be Lehman Brothers' bankruptcy in 2007 and its effect on the global financial industry. Each asset you have in your portfolio will have some risk associated with it. For example, a new cryptocurrency without a large market for buyers will have more liquidity risk. But the risk won't always be internal and manageable with your portfolio. Sometimes external factors like our Lehman Brothers example or a global recession can't be avoided. So how do you begin to assess these risks, the likelihood of encountering them, and their severity? An excellent place to start is by ranking your investments from high risk to low risk. From there, you can check each asset's price volatility, liquidity, industry health, and other related news. After identifying your higher risk investments and the kinds of risks they have, The next step is to decide how much you want to offset that risk. For example, if you have many crypto investments, you may want to balance this out and diversify with government bonds or other low-risk investments. You can also allocate your assets strategically within an asset class, such as stocks or crypto. For example, you could get stocks in utilities or technology companies if you have a high systemic risk from holding stocks all within the financial industry. Great! You should know by now the most essential concepts within portfolio and risk management. In this module, we will begin learning about different trading and investing strategies. Let's start with day trading. If you've ever watched movies about trading and Wall Street, you're probably already familiar with what day trading is. While the movies can be a little outdated with stockbrokers shouting over each other furiously on the trading floor, the basic concept still stands. As you might have guessed from the name, day trading is the entering and exiting of all trades within the same day. This means a day trader starts their day holding no stocks, purchases them during the day, and sells them by the end of the day. With traditional markets, this occurs within an exchange's trading hours. For example, a trader may start at 9:30 in the morning when the New York Stock Exchange opens. They have no open positions at the moment, meaning they currently own no shares. The trader begins to look for stocks they believe will rise in value within the trading day. They can base their decisions perhaps on some expected news a company will release that day, the price of a stock at closing time the day before, or other information. For example, the day trader begins to buy Boeing and Coca-Cola stock. Boeing is due to release details of the development of a new plane at midday. And Coca-Cola finished its trading day yesterday at an undervalued price after a big sell-off. Over the day, both stocks begin to rise and the trader sells them for a profit. In our previous lessons, you'll remember that technical analysis is well suited to short-term trading. Gains in such a short period can be minimal, and sometimes don't just rely on the fundamental value of an asset. Day trading is a very active trading strategy that requires a significant time investment. It can be highly profitable, but it also has a substantial amount of risk. As such, day trading is generally better suited to experienced traders. Next, let's get into the basics of swing trading. It has some similarities with day trading, but works on a longer time frame. Positions are usually held anywhere from a couple of days to a couple of months. The goal here is to profit from larger swings in price. Your goal as a swing trader is to identify assets that could be undervalued and are likely to increase in price. In this case, you would purchase this asset and sell it when the price rises to generate a profit. The opposite trade looks to profit from downward price swings. If your analysis tells you that a bear market for gold might be coming to an end, you could purchase gold in anticipation of rising future prices. However, the transition between a bear and bull market can take place over months. In this case, you purchase gold now, waiting for the price to increase in the next 1 to 2 months. If the price does rise, you sell off the asset and take home your profit. You can also short the market in swing trading. This means borrowing overpriced assets and then repurchasing them at a lower price. For example, Bob's analysis predicts that Ether's price will drop from 2,000 to 1,000 in 2 weeks. Bob borrows 1 Ether, sells it for 2,000 today, and waits to see if his prediction is correct. 2 weeks later, Ether has dropped down to $1,500. Although he wasn't 100% accurate with his analysis, Bob still has the opportunity to make some profit. Bob repurchases back 1 Ether for $1,500 and returns the Ether back to the lender, leaving him with $500 in profit. Swing traders commonly use technical analysis like day trading, but as their strategy plays out across a more extended period, fundamental analysis is also a valuable tool for swing traders. Using them both together can create an even more robust analysis to base your trades on. Swing trading requires less of a time investment than day trading, significantly reducing the stress and adrenaline traders will feel. Compared to day trading, swing trading is a much more suitable strategy for beginners. In the next module, we will learn 2 different strategies called scalping and buy and hold. Let's start this module with the trading strategy called scalping. While day trading takes place over a day, it's possible to trade on even shorter time frames. Scalpers try to game small fluctuations in price, trading large amounts over minutes or even seconds. Scalpers predominantly use technical analysis to make their trading decisions. The difference between the price people are selling and people are bidding, known as the spread, is also an excellent opportunity for profit. Some investors are willing to buy an asset at a slightly higher price or sell at a slightly lower price in order for their trades to take place instantly. A scalper offers this liquidity to the market and makes money off the spread. For example, Bob wants to sell cryptocurrency A for $10, but scalpers and other buyers want it for the lower price of $9.95. Bob offers the crypto to the market at $10, but he doesn't get any takers. Bob's in a rush to sell, so he chooses to sell it for $9.95 to a scalper. Another investor, Alice, wants to purchase cryptocurrency A for $9.95, but sellers and scalpers only offer to sell it at $10. Alice is also in a rush, so she decides that she will meet the scalper's offers and purchase cryptocurrency A for $10. The scalper uses the crypto he bought from Bob for $9.95 and sells it to Alice for $10. The scalper makes a profit of 5 cents on each unit of cryptocurrency A that he sells. This is a small amount, but they can make larger profits if they do this transaction over hundreds of thousands of units in a day. Scalping is definitely not a beginner strategy. An in-depth understanding of the markets, their mechanisms, and technical analysis is needed to succeed in scalping. That said, for traders that know what they're doing, identifying the correct patterns and taking advantage of short-term fluctuations can be highly profitable. If that sounds too complicated for you and you're looking for the least time involvement in your trading strategy, buy and hold is probably your best bet. It involves buying and holding an asset over a long period. It's a long-term passive play where you purchase an asset and leave it alone regardless of market conditions. This strategy is known in the crypto sphere as hodling. Investors can buy and hold a coin or token for years instead of actively trading. This is a great approach for someone that prefers to be hands-off and not worry about short-term fluctuations. If you look over the past 10 years, one of the most successful buy and hold strategies has been to purchase Bitcoin and let it accumulate value. While this sounds easy to do, buying and holding requires patience on the investor's part. Through that time hodling Bitcoin, you would need to hold your nerve and not panic sell in any of the multiple bearish market dips. Now you know some commonly used trading strategies. Let's review several essential technical analysis indicators that would come in handy for your trading in the next module. Traders rely on indicators to help execute their trading strategies. There are many indicators out there, but how do you know which ones are the best for you? Well, every trader will tell you something different. Some like to look at market momentum, while others want to filter out market noise or measure volatility. In this module, we will review 3 popular indicators widely used by traders. The first is called Relative Strength Index, also known as RSI. It's a momentum indicator that shows whether an asset is overbought or oversold. It does this by measuring the magnitude of recent price changes. The data is then displayed as an oscillator that can have a value between 0 and 100. Since the RSI is a momentum indicator, it shows the rate, or the momentum, at which the price is changing. This means that if momentum is increasing while the price is rising, the uptrend is strong and more buyers are stepping in. In contrast, if momentum is decreasing while the price is rising, it may show that sellers might soon take control over the market. A traditional interpretation of the RSI is that when it's over 70, the asset is overbought, and when it's under 30, it is oversold. As such, extreme values may indicate an impending trend reversal or pullback. The second indicator is called the moving average. A moving average smooths out price action by filtering out market noise and highlighting the direction of the trend. The 2 most commonly used moving averages are the simple moving average and the exponential moving average. The simple moving average is plotted by taking price data from the defined period and producing an average. For example, the 10-day simple moving average is plotted by calculating the average price over the last 10 days. The exponential moving average, on the other hand, is calculated in a way that gives more weight to recent price data. This makes it more reactive to recent price action. The moving average is a lagging indicator. The longer the period, the greater the lag. As such, the 200-day simple moving average will react slower to recent price action than the 50-day simple moving average. Traders often use the relationship of the price to specific moving averages to gauge the current market trend. For example, if the price stays above the 200-day simple moving average for a prolonged period, The asset may be considered to be in a bull market by many traders. Traders may also use moving average crossovers as buy or sell signals. For example, if the 100-day simple moving average crosses below the 200-day simple moving average, it may be considered a sell signal. The last indicator is Bollinger Bands, a measure of the volatility of the market. It can also be used as an indicator of overbought or oversold conditions. Bollinger Bands are made up of 3 lines: a simple moving average, which is the middle band, and an upper and lower band. The settings may vary, but typically the upper and lower bands are 2 standard deviations away from the middle band. As volatility increases and decreases, the distance between the bands increases and decreases as well. Generally, the closer the price is to the upper band, the closer to overbought conditions the charted asset may be. Conversely, the closer the price is to the lower band, the closer to oversold conditions it may be. For the most part, price will stay within the bands, but on rare occasions it may break above or below them. While this event may not be a trading signal in itself, it can act as an indication of extreme market conditions. Another important concept of the Bollinger Bands is called the squeeze. It refers to a period of low volatility, where all bands come very close to each other. This may be used as an indication of potential future volatility. Conversely, if the bands are very far from each other, a period of decreased volatility may follow. Now, you understand portfolio and risk management, different trading strategies, how to read essential trading indicators. Let's put what we've learned together to build a well-balanced crypto portfolio in the next module. How to build a well-balanced crypto portfolio? Getting started with crypto investing is as easy as purchasing your first Bitcoin, Ether, or any other cryptocurrency. After that, building a well-balanced crypto portfolio is not that different from balancing a traditional stock portfolio. When creating an investment portfolio, you should be familiar with the concepts of asset allocation and diversification. Asset allocation refers to investing in different asset classes, such as cryptocurrencies, stocks, bonds, precious metals, and cash. Diversification relates to the distribution of your investment funds across different assets or sectors. Technically, cryptocurrencies are a single asset class, but in a cryptocurrency portfolio, you can diversify across products, coins, and tokens that present different goals and use cases. For example, one way to allocate a portfolio could be 40% Bitcoins, 30% stablecoins, 15% NFTs, and 15% altcoins. Most advice will tell you that your crypto portfolio has to be diversified. While it is a standard practice for investors, there are pros and cons to spreading your capital around different assets. A diversified portfolio reduces overall risk and volatility. Losses can be offset by gains to keep your position stable. Your portfolio also has more opportunities to make gains with each additional coin you own. However, the more diversified your portfolio is, the closer it will track the overall market. Most traders and investors are looking to beat the market with larger gains. A highly diversified portfolio will lead to more average returns than a successfully concentrated portfolio. Managing a diversified portfolio also requires more time and research. To invest soundly, you should understand what you are buying. With a large portfolio, the chances of understanding everything decrease. If your portfolio is across different blockchains, you may also need to use multiple wallets and exchanges to access your assets. The decision to diversify or not is yours. It depends on your risk profile and investment style, but some diversification is always recommended. Aside from diversifying your portfolio across different types of coins and tokens, you can also consider using crypto financial products to help further diversify your portfolio. You can think of them a bit like investing in ETFs or mutual funds rather than just holding shares. There's a massive amount of products you can invest in across different blockchains and DApps. Finally, you can use a portfolio tracker to manage your crypto portfolio. A portfolio tracker is a program or service that allows you to trace the movements of your holdings. You can see how your current allocation stacks up with your long-term goals and track your progress. Some popular trackers include CoinMarketCap, CoinGecko, and Delta. To summarize, each investor or trader will have their own ideas on what makes a well-balanced crypto portfolio. But here are some general rules worth considering. 1. Split your portfolio between high, medium, and low-risk investments and give them appropriate weightings. A portfolio containing a large portion of high-risk investments is definitely not balanced. It might have the chance to provide you bigger gains, but may also cause huge losses. Your risk profile will determine what's best for you, but there should be some mix. 2. Rebalance your portfolio if needed. The crypto market is very volatile, and your decisions should change according to the current market condition. 3. Allocate new capital strategically to avoid overweighting any one area of your portfolio. If you've made big gains recently from one coin, it can be tempting to pump in more money. Don't let greed interfere, and think about where you can better place the money. Lastly, remember to always do your own research and only invest what you can afford to lose. Your portfolio isn't correctly balanced if you feel stressed about it. Your positions should not cause you serious consequences in case things go terribly wrong. Congratulations! You've completed Binance Academy's course on trading and investing strategies. Hope this course has been helpful in your trading and investing journey in crypto. In this course, you will learn the most essential concepts in decentralization, including DeFi, DAO, DApps, and smart contracts. If you don't know what these terms mean, don't worry. You'll understand them after completing this course. In this first module, we will introduce you to DeFi, which stands for Decentralized Finance. A core concept of blockchain technology is decentralization, meaning the control of decision-making and execution is transferred from a centralized entity to a distributed network. One major use case of blockchain technology is in financial services, and DeFi refers to an ecosystem of financial applications built on blockchain networks, especially those governed by smart contracts. DeFi aims to create an open-source, permissionless, and transparent financial services ecosystem that is available to everyone and operates without any central authority. Moreover, users would retain complete control over their assets and interact with this ecosystem through peer-to-peer decentralized applications. The term DeFi was created in 2018 by several Ethereum developers, but the actual DeFi movement arguably started with the creation of Bitcoin in 2009. Bitcoin could be considered the first peer-to-peer digital money built on blockchain technology, which can be classified as DeFi. The real milestone in DeFi, however, is the launch of the Ethereum network in 2015. Ethereum introduced smart contracts, a more versatile programming language, and the ERC20 token standards. The protocol supports smart contracts that provide functions suitable for financial services, such as decentralized asset lending. The Ethereum network quickly began attracting developers to build all kinds of DApps, making Ethereum the foundation for DeFi applications. The DeFi space experienced exceptional growth after that. The total value locked in DeFi, which measures the total funds deposited in DeFi protocols, grew from $250 million in the beginning of 2019 to a peak of $250 billion at the end of 2021. Some notable DeFi applications include stablecoins, decentralized exchanges, lending, and borrowing protocols. We will go into more detail in the next module when we discuss specific use cases of DeFi. From the user's perspective, the core benefit of DeFi is enabling easy access to a wide range of financial services, especially for those isolated from the traditional financial system. The most significant difference between DeFi and traditional finance, or TradFi, is arguably accessibility. Anyone can create a crypto wallet and begin using DeFi services as long as they can access the internet. There are no signups, no minimum account balances, or identity verification that TradFi institutions require. This means DeFi can help improve financial inclusion by serving the unbanked. You probably heard about CeFi, which stands for Centralized Finance. It's a world where financial services are managed by centralized financial institutions. I know it's confusing, but even inside the crypto world, not every financial service is decentralized. When we say CeFi in the crypto space, it generally refers to crypto trades that are handled through a centralized exchange. For example, staking tokens to earn rewards through a centralized exchange often requires users to use a custodial wallet and to trust the centralized exchange. CeFi still dominates many aspects of the crypto world. As of 2021, over 90% of crypto trading volume took place on centralized exchanges. DeFi, on the other hand, doesn't involve any middleman. Decentralized exchanges complete trades via self-executing smart contracts and peer-to-peer transactions. Users interact with their own personal wallets and don't have to deposit crypto with a third party. Both DeFi and CeFi have their advantages and limitations. CeFi provides convenience and reduces the technical complications of managing various DeFi products on your own. CeFi also offers fiat to crypto trading services, and major platforms provide customer support. While DeFi gives users complete control over their crypto, more privacy, and many other attractive features, it has its limitations. It requires a lot of experience and research in addition to potential technological failures, lack of cross-chain services, and security risks. Specifically, because DeFi applications transfer the responsibility from the intermediaries to the user, it has potentially more risks relating to user errors. DeFi is also currently a cluttered and risky ecosystem. It can be a daunting task for users to find the most suitable application for a specific use case. When you explore DeFi services, you also need to bear in mind the many risks you face, including counterparty risk, regulatory risk, software risk, and risks relating to low market cap tokens. Despite these limitations, DeFi is always evolving and innovating. Its many advantages can potentially bring enormous benefits to populations globally, particularly those left outside of traditional financial markets. In the next module, let's explore some specific DeFi use cases and how they differ from traditional financial services. DeFi refers to an ecosystem of financial applications built on blockchain networks. You might think that sounds nice, but what can you really do with DeFi? Well, with a crypto wallet and some crypto, you can access a range of financial services, including borrowing, lending, payment, staking, and swaps, if you're in a country where such services are permitted. With a few clicks on a computer or smartphone, you can enjoy many financial services that usually would require a bank visit and many complicated procedures. This module will explain how some of the most popular DeFi products work and how you can use them. As of 2022, most DeFi services are for lending and borrowing, staking, and liquidity pools. Financial services such as mortgages and insurance are also natural use cases for DeFi, but we are still at a very early stage for these. Blockchain-based insurance, for example, is mostly confined to insurance for certain types of crypto deposits and investments. Before we get into these DeFi services, we must first explain the concept of a stablecoin. A stablecoin is a type of cryptocurrency whose price is typically pegged to other assets, like the US dollar or gold. The pegging mechanism is designed to achieve price stability of the stablecoin. You may ask, why do we need stablecoins? Well, you know that crypto prices are very volatile. Suppose you put up some Bitcoin as collateral to borrow $1,000. If Bitcoin price goes down a lot, your lender may become nervous and ask you to put up more Bitcoin as collateral, or sell your Bitcoin so that the lender can get the money back. If you can use cryptos with relatively stable prices as collateral, then this problem can be alleviated. The need for cryptos with price stability exists in most crypto transactions. That's why stablecoins are a vital component of the DeFi ecosystem. Now that we know what stablecoins are, let's go into crypto borrowing and lending, which is among the most popular applications in the DeFi space. Crypto lending works by taking crypto from one user and providing it to another with interest. In most cases, the loan taker must put up some collateral before borrowing any crypto. On the other side of the loan, you may have a smart contract that mints stablecoins to lend out, or a platform lending out funds from another user. The exact method of managing the process changes from platform to platform. You can find crypto lending services on centralized and decentralized platforms, but the core principles remain the same. Crypto borrowing and lending is usually done without credit checks, and loan transactions are settled instantly. These features could be a boon or a bane. You need to be careful with various risks that could lead to losses. Another popular DeFi application is decentralized exchanges, often called DEXs. These platforms allow users to trade or swap digital assets without a trusted intermediary. The trades are made directly between user wallets with the help of smart contracts. Some exchanges, known as automated market makers, use liquidity pools to facilitate trading without directly needing a counterparty to match your trade. You can think of them as a robot, always willing to quote you a price between two assets, essentially allowing anyone to become a market maker on an exchange and earn fees for providing liquidity. Another popular DeFi service is yield optimization, also known as yield farming. This refers to DeFi DApps that automate and optimize the yield gained from reward pools, staking, and other interest-bearing products. If these DeFi products sound attractive, you might wonder, where can I access DeFi products? Ethereum has long been the traditional home of DeFi. However, there are now many blockchains with healthy DeFi ecosystems. Almost any network with smart contract capabilities can host DeFi DApps. Finding credible DeFi protocols requires extensive research. Online forums, messengers, and websites can help you learn about new opportunities. However, you need to be extremely careful with any information you find. Always be cautious and double-check the safety of any DeFi products you read or hear about. In the first two modules, we have discussed smart contracts and DApps without explaining precisely what they are. We'll do that in the next module. Smart contracts are a crucial element for DeFi products to function. So, what exactly are smart contracts? Let's start with a brief history of the concept behind them. Lawyer and computer scientist Nick Szabo first described the idea of smart contracts in the 1990s. A smart contract is a tool that formalizes and secures computer networks by combining protocols with user interfaces. Potential uses were envisioned in fields involving contractual agreements, such as credit systems and content rights management. But it was only after the launch of the Ethereum network in 2015 that smart contracts gained wider adoption. In the world of cryptocurrencies, a smart contract refers to self-executing computer programs that run on the blockchain when predetermined conditions are met. The conditions are predefined by computer code, which is replicated and executed by all network nodes. Blockchain smart contracts allow for the creation of trustless protocols. This means that two parties can make commitments via blockchain without having to trust each other. They can be sure that the contract won't be executed if the conditions aren't fulfilled. Each blockchain may present a different method of implementing smart contracts. In this module, we will focus on the smart contracts that run on the Ethereum network. So, how does a smart contract work specifically? Because a smart contract executes a particular task when certain conditions are met, it often follows the if-then computer programming statement. A smart contract contains lines of computer codes that say, if X condition is met, then Y will be executed. Please note that despite the terminology, smart contracts are not legal contracts. They're just a piece of computer code running on the blockchain. As a matter of fact, smart contracts exist so that legal contracts don't have to be made. There's no need to get a lawyer, a court, or a government to enforce contract law if everything that needs to happen in an agreement happens automatically when the predefined conditions are met. As the saying goes, in code we trust. Smart contracts have unique characteristics. Ethereum smart contracts often are distributed, meaning that smart contracts are replicated and distributed in all nodes of the Ethereum network. Ethereum smart contracts are also deterministic. They only perform the actions they were designed to when the requirements are met. The outcome will always be the same. Ethereum smart contracts are immutable, meaning the execution is automated, and the smart contracts can't be changed after deployment. They can only be deleted if a particular function was previously implemented. Smart contracts are also transparent, with their code visible for everyone to see. Smart contracts can be used for various use cases, including DeFi, voting systems, and games. As we explained in the previous modules, DeFi transactions are completed via smart contracts. Smart contracts can also be deployed with other blockchain solutions in the healthcare, supply chain, and governance sectors. Of course, smart contracts have their limitations. Because people write the computer code in smart contracts, they are subject to human errors. The immutability of smart contracts also makes fixing any mistakes very difficult. For example, millions of dollars worth of Ether was stolen when a decentralized autonomous organization called the DAO was hacked in 2016. The hackers took advantage of flaws in its smart contract code. Since the smart contract was immutable, it was challenging for developers to fix the code, and it was impossible to reverse the fraudulent transaction on the blockchain. This eventually led to a hard fork, giving birth to two separate Ethereum chains. Let's move on to DApps. As you probably guessed by now, DApps are applications that run on blockchain networks. DApps can perform functions that are similar to applications on your phone or computer, but the back-end system is different. DApps rely on smart contracts on a distributed network to function, unlike standard mobile apps that rely on centralized systems. Similar to smart contracts, DApps are open source, meaning anyone can verify, use, copy, and modify the source code. All information of DApps is cryptographically secured and stored on a public decentralized blockchain, maintained by a network of nodes. Another characteristic of DApps is that they can be accessed with a cryptographic token. Today, DApps generally refer to all applications with smart contract functionalities running on blockchain networks. You can think of smart contracts as a core component of DApps, while DApps are the product that provide a complete application experience to users. There is a great variety of DApps with different use cases, such as gaming, social media, entertainment, and of course, DeFi. As of mid-2022, most DApps exist on the Ethereum network, but developers are building DApps on many other blockchains. As of mid-2022, there are a large number of DApps, and the sector is still in the early stages of development. Despite DApps facing scalability and code modification difficulties, particularly on the Ethereum network, the industry is expected to grow in applications and active uses as decentralization becomes widely adopted. In the next and last module, we will learn what a decentralized autonomous organization is. We've learned how smart contracts and DApps make decentralized transactions and applications possible. The next level of complexity comes in the form of a decentralized organizational structure. This is where a decentralized autonomous organization, or DAO in short, comes in. A DAO is an organizational structure or substructure commonly used for DApps, blockchain projects, socio-political funds, and crypto investment funds. With no central authority, token holders of a DAO collectively cast votes for the management of the DAO. All votes are posted on a blockchain for public viewing. Because of their decentralization and transparency, as well as their ability to work with self-executing smart contracts, DAOs have become a popular governing method in the blockchain and crypto space. How does a DAO work? Token holders of a particular project can vote on issues that must be decided. The voting power is distributed generally based on the number of tokens users hold. The decisions to be voted on are written as proposals in smart contracts, and users must select between mutually exclusive options. After token holders vote, and based on the outcome of the votes, the smart contracts are automatically executed to implement the decision. Some issues that token holders vote on include whether to issue more tokens, whether transaction fees should increase, or whether a certain number of tokens should be burnt. A token burn means taking tokens out of circulation permanently. A crypto investment DAO's token holders might vote on which investment strategy to use. A socio-political DAO's token holders may vote on how the funds in the DAO will be dispersed and for what purposes. The logic behind why a DAO works is about making assumptions about incentives. Users who own tokens in a project have voting power. The more tokens you own, the more voting power you have. Therefore, users are incentivized to act in good faith to keep the project healthy and robust. They will harm themselves if they do bad things because their token's value will be jeopardized. There are many benefits of a DAO. Without a central authority, a DAO distributes the decision-making power to a group of mostly anonymous users who have skin in the game. It makes the decision-making process aligned, as the decision-makers are the ones who will be impacted directly by their decisions. Token holders also feel a sense of ownership and empowerment when they have a direct say in decision-making. Because DAOs rely on smart contracts, the voting process is less at risk of human input errors. A proposal posts the results on-chain, which automatically triggers the proposed change based on voting results. It also means new proposals can't be censored, and votes can't be technically rigged. But the development of DAOs has faced challenges. One of the earliest well-known DAOs was an investor-directed venture fund built on the Ethereum blockchain in 2016 called the DAO. 3 weeks into its token sale, however, the DAO suffered an attack due to a bug in the code, and millions of dollars worth of crypto was stolen from the DAO. The funds were later restored, but it highlights the risks of DAOs. When you only need to trust the code can become your greatest risk. The regulatory environment surrounding DAOs is also uncertain. How different jurisdictions will create the regulatory framework around these new types of organizations remains to be seen. The desirable properties of DAOs, such as decentralization and immutability, also carry performance and security drawbacks. It's not complicated to create a DAO. Still, if you ever consider doing so, you should remember that a DAO needs a purpose, a voting mechanism, a governance token, and a healthy community to succeed. Well, we've covered DeFi, smart contracts, DApps, and DAOs in this decentralization course. In the broadest definition, decentralization refers to dispersing functions and power away from a central authority to a distributed network. This enables different parties to work together without having to trust each other. Blockchain technology is the critical technology enabling such decentralization across numerous fields. DeFi, smart contracts, DApps, and DAOs are the use cases and tools that propel the evolution toward decentralization. Of course, decentralization won't be a cure-all solution. No single technology can ever be. But adoption of decentralization can serve to counter some of the weaknesses of the traditional paradigm of hierarchy and central authorities. In this course, you will learn the basics of Web3, the Metaverse, non-fungible tokens, and GameFi. Blockchain technology is a critical component of the future megatrends of our digital world. In this first module, we explain the concept of Web3, a term you've probably already heard much about. To know what Web3 is, we need to first understand Web 1.0 and Web 2.0. Web 1.0 refers to the first version of the web during the early 1990s. A few people created static and primarily text-based web pages for a large group of readers to read. This publisher-centric Web 1.0 can be called the read-only web, designed to help people find information with little interactivity. There was almost no way for users to interact with the information or upload their own data, except through simple text-based chat messages and online forums. In 1999, author and web designer Darcy DiNucci coined Web 2.0 to distinguish it from Web 1.0. Web 2.0 refers to the shift towards a more interactive internet focused on the users participating and contributing to the web. If Web 1.0 was the read-only web, then Web 2.0 was the read and write web, or participatory web. This platform-centric Web 2.0 emphasizes user-generated content in portals such as social media platforms, blogs, and podcasts. It also features improved interactivity, as the user experience moves from static to dynamic. Short video apps, for example, give each user a customized interaction with user-generated content based on personal interests and algorithmic recommendations. The term Web3 was coined by Ethereum co-founder Gavin Wood in 2014 to describe a decentralized internet based on blockchain technology. As Web3 is still a nascent iteration of the future web, there are different opinions on what it should be. But generally, Web3 is envisioned as decentralized, open, and places the users at the center. If Web 1.0 is the read-only web and Web 2.0 is the read and write web, then Web3 is the read, write, and own web. A core vision of Web3 is to counter the weaknesses of Web 2.0, which saw a handful of giant tech platforms dominating digital lives globally. Internet tech giants were able to distribute, censor, and monetize the data and content that everyone else was publishing on the internet. They often also created barriers to entry so that other platforms and individuals would not threaten any monopolistic strongholds they may have. Web3 is envisioned to allow users to move to decentralized platforms with greater control of their personal data, enjoy greater privacy, and be rewarded for the data or content that they choose to share. Users can interact, exchange information, and conduct peer-to-peer financial transactions, becoming content owners instead of just content users. Non-fungible tokens, or NFTs, are thought to be an early version of a technology that lets users become owners of their data and creations. Blockchain will also enable permissionless digital identities with the usage of crypto wallets, leading to more inclusive and equitable digital economies. Another essential feature of Web3 is what's called the semantic web, which means computers can understand and use information just as humans can. With the help of artificial intelligence, rules for handling data, and better sensor hardware, the world's information will serve our needs dynamically and intelligently. An example is how artificial intelligence enables drug development and content creation more efficiently. How does blockchain fit into Web3? The open, censorship-resistant, user-owned, trustless Web3 of the future needs new technologies, and blockchain provides an answer to many of these Web3 goals. Although blockchain technologies are still in development, they attempt to answer the question of how to manage a decentralized ecosystem. Built on blockchain technology, many crypto products are expected to play critical roles. Blockchain-based digital identity, crypto wallets, DeFi services, NFTs, and tokenizations are some of the crypto's existing tools that can be readily applied toward building the future Web3 ecosystem. With the massive explosion of data, websites, and applications, Web3 promises a more open, equitable, and intelligent digital future. While no one can accurately predict what Web3 will ultimately look like, it's up to entrepreneurs and users today to build the next chapter of the internet. There will be enormous opportunities for those who can contribute to this evolution. In the next module, we'll look into the Metaverse, a concept closely related to Web3. Web3 and the Metaverse are often talked about together when people discuss what's next for the internet. The two concepts are closely related, but they approach the next chapter of the internet from different perspectives. While Web3 focuses on the relationship between users and information and who controls it, the Metaverse concentrates primarily on how the information is presented and how users experience it. Web 1.0, Web 2.0, and Web 3 describe the evolution from the read-only web, the read and write web, to read, write, and own web. The Metaverse is an evolution from two previous iterations of the internet, when users first accessed primarily text-based information, then consumed information in the form of text, images, videos, and real-time live streams. The Metaverse envisions a future where users consume information in a fully immersive, virtual, real-time, and three-dimensional interface. Some even believe that users might experience the Metaverse involving all five senses, making the Metaverse essentially an alternative reality. The Metaverse concept was coined by author Neal Stephenson in his 1992 science fiction novel, Snow Crash. The term gained popularity over the last few years as the idea of a virtual reality-based Internet of Experience caught the public's imagination. Sales of virtual reality headsets increased, and video games with virtual world elements became popular. These games provide the closest Metaverse experience for consumers today. Despite some initial progress toward the Metaverse, there are still different opinions about what the Metaverse is or should be. There are some people who believe that the Metaverse will be driven by virtual reality, with users wearing VR headsets, fully immersed in virtual worlds, and disconnected from their real environment. Another camp believes that augmented reality should be the primary mode of interaction. Users wear AR glasses or other interface devices to access an extra informational layer of perception while staying present with their physical environment. Other companies believe mixed reality is a better option, where users interact with physical and virtual items. Mixed reality allows users to immerse themselves in the real world while interacting with virtual environments, essentially enjoying the benefits of both worlds. Still, others believe digital twins will be what makes the Metaverse genuinely revolutionary. Digital twins are a real-time virtual representation of physical objects or processes. The Metaverse will likely include all the above elements, each serving different purposes. But one thing is certain: blockchain and cryptocurrencies are likely essential components of the Metaverse. When we work, socialize, and purchase digital items in the Metaverse, we need a secure way of showing ownership of digital items and transferring such ownership between people regardless of the platform they exist on. Digital money that can cross borders easily will be needed for a global, borderless Metaverse. We will also want to participate in governance if the Metaverse is a large part of our lives. Future iterations of current blockchain technologies are what will be used in the Metaverse, although we can already see their applicability today. For example, blockchain-based wallets will enable people to have digital identities and own digital assets. Cryptocurrencies are easier to audit than in-game currencies, and it is easy to transfer and convert digital currency via the blockchain, whereas centrally administered in-game currencies and assets are not transferable among different gaming ecosystems. Moreover, just as we can establish who owns something, we can also show that an item is original and unique using blockchain technology. This ability is critical in the metaverse because digital objects can be easily copied. Governance tokens and DAOs provide the tools for decentralized decision-making, allowing users to control the rules of their interaction with the metaverse. In fact, early blockchain-based metaverse projects already exist and are experimenting with new business models. Play-to-earn games, for example, are built with blockchain technology and let users play games to generate income while having fun. The metaverse is an exciting future chapter of our digital lives, and blockchain is a core engine powering that future. In the following 2 modules, we will learn about GameFi and NFTs in more detail. A non-fungible token, or NFT, is a type of cryptographic token representing a unique asset. NFTs are tokenized certificates of digital or real-world assets. They function as verifiable proofs of authenticity and ownership using a blockchain network. NFTs are non-fungible, which means they are not interchangeable with each other. Such a feature introduces scarcity to the digital world. On the other hand, all fiat currencies and most cryptocurrencies like Bitcoin and Ether are fungible. Being fungible means an asset's individual units are interchangeable and indistinguishable from each other, making them perfect as a medium of exchange. Why did people create NFTs? When the world became increasingly digital, people were able to make copies of digital goods easily, such as pirated movies or copied software. Centralized systems were created to reduce those illegal activities. Today, it's extremely hard to download music and movies illegally online. But it remains incredibly easy to make digital copies of many things, and it's hard to prove ownership of digital goods. NFTs allow digital goods to have verifiable scarcity and provable ownership based on blockchain technology. Unlike cryptocurrencies, NFTs are individually unique and are therefore a great solution for representing ownership of unique assets. That's why NFTs are often referred to as crypto collectibles. While it's still possible to copy digital goods, NFTs make it very easy to determine whether someone selling or distributing a copy of a digital asset is its real owner. NFTs are primarily used to represent ownership of digital items, although they can also certify ownership of physical items in the real world. Similar to cryptocurrencies, NFTs can be traded in open marketplaces, but it's worth noting that the value of each NFT is unique. Both cryptocurrencies and NFT prices are volatile, so be cautious if you invest in them. NFTs have the potential to be one of the critical components of a blockchain-powered digital economy and Web3. They could be used in many different fields such as video games, digital identity, licensing, ticketing, membership, certificates, fine art, and fractional ownership of assets. NFTs can be used by DApps to issue unique digital items and crypto collectibles. As unique collectibles, these tokens have a resale value on the market, and the NFT market has been growing rapidly in trading volume despite being volatile, like the overall crypto market. Another benefit of NFTs is that they could mitigate some common problems faced by many online gaming ecosystems. Some online games have already built sizable gaming economies. Using blockchain to tokenize gaming assets is a solution to alleviate challenges, such as management of gaming economies and proof of ownership. Depending on the blockchain they are minted on, NFTs could also allow players to take some of their in-game assets outside of the game ecosystem, allowing gaming worlds to connect to each other. While NFT usage in the virtual world is already flourishing, another exciting use case of NFTs is the tokenization of real-world assets. These NFTs can represent fractions or collections of real-world assets that can be stored and traded as tokens on the blockchain. This could introduce some well-needed liquidity to many markets that otherwise wouldn't have much liquidity, such as fine art, real estate, and rare collectible items. For example, a person may want to buy a piece of physical art to sell later, but lives on a different continent from where the artwork is currently stored. Instead of packing, moving, finding a new storage facility, and unpacking the artwork, an NFT certificate of ownership can be minted and transferred to the new owner, and along with it, the responsibility for paying for ongoing storage. Easy and trustless transfers of these assets could reduce friction in the global economy. Digital identity is another sector that can benefit from the properties of NFTs. Storing identification and ownership data on the blockchain would increase privacy and data integrity because blockchains are more secure than centralized databases. NFT virtual land on Metaverse platforms is another promising use case. NFTs are perfect for representing virtual land ownership because each piece of land is unique. Landowners can use their plots to do many things, including hosting online events, displaying content, and advertising. NFT virtual land will likely continue to progress as we move closer to a metaverse future. If you want to create or mint your own NFT, it's a straightforward process. There are various standards to do this. The most prominent is ERC 721, a standard for issuing and trading non-fungible assets on the Ethereum blockchain. An improved standard is ERC 1155 on the Ethereum blockchain. It enables a single contract to contain both fungible and non-fungible tokens, opening up a new range of possibilities. Ethereum has traditionally been the home of NFTs and their development. It has a large user base and well-established NFT community, but transaction fees are very costly. There are a growing number of blockchain networks that you can use to mint NFTs, with some solving the problem of high transaction fees on the Ethereum network. You may wonder what gives NFTs their value? Why would someone be willing to pay money for a digital picture when you can just save the file from the internet? The value of an NFT works in a similar way to a piece of art. If you can prove that you own an original Picasso painting, then you can sell it for a lot of money or brag about your ownership. Anyone can make a copy of a Picasso painting because it's in the public domain, and if it's on display, anyone can look at it. But copies and viewing access do not diminish the value of a Picasso. Perhaps they even enhance it. The same goes for collectibles like rare baseball cards or collectible game cards. Proof of ownership and the rights that go along with that ownership are what NFTs represent. The most important thing you should remember about NFTs is their unique properties and potential use cases. It looks certain that NFTs are likely here to stay and become even more prevalent as we move closer to Web 3. GameFi is a fusion of the words game and finance. It refers to play-to-earn blockchain games that offer economic incentives to players. Players can earn cryptocurrencies and NFT rewards by completing tasks, battling other players, and progressing through different game levels. Unlike traditional video games, most blockchain games let players transfer gaming items out of the game's virtual world. This allows players to trade the items and crypto assets they have earned in the game on NFT marketplaces and crypto exchanges. GameFi has been growing rapidly since play-to-earn games became popular in 2018. The growth of DeFi helped boost the adoption of GameFi by providing the infrastructure needed to enable users to launch and trade their in-game tokens. The growth of the NFT market and the large amounts of money that began exchanging hands also pushed the development of GameFi. How do players get rewarded in GameFi? In GameFi, the reward can come in different forms, such as cryptocurrencies or in-game assets like virtual land, avatars, weapons, and costumes. Each GameFi project will adopt a different model and game economy. In most cases, the in-game assets are NFTs residing on the blockchain, meaning they can be traded on NFT marketplaces. In other cases, however, the in-game assets must be converted into NFTs before players can trade or sell them. Typically, the in-game assets also provide specific benefits to the players, allowing them to earn more rewards. But some games also feature collectibles, avatars, and cosmetics that are purely visual items and have no impact on the gameplay. Depending on the game, players can earn rewards by interacting with the game world, completing tasks, battling with other players, or building structures on their plot of land. Taking a page from DeFi, some games also let players generate passive income without playing the game, either through staking or lending their gaming assets to other players. At the core of GameFi projects, play to earn is a revolutionary and financially attractive model for people who play games. It gives players complete control and ownership over their in-game assets while offering opportunities to turn game assets into financial ones. It's different from the pay-to-play model adopted by traditional video games. Pay-to-play requires gamers to invest before they can start playing. For example, some video games require players to purchase licenses or pay subscriptions. Many games even have a pay-to-win model, where players have to spend more money to buy exclusive in-game content or in-game resources so that they can get an edge in the game. In traditional games, players can earn in-game currency and collect digital assets, but these items can't, or aren't supposed to, be traded outside of the game. In most cases, they don't carry any value beyond the scope of the game. Even when they do, players are often prohibited from monetizing or trading their assets in the real world. The gaming company usually controls and holds the in-game assets. Despite the innovative game economy in GameFi, keep in mind that things differ depending on specific GameFi projects. Blockchain technology can and should give players complete control over their in-game assets, but that's not always the case just because a game is blockchain-based. Another thing to note is that most play-to-earn games are free to play, but some GameFi projects require you to purchase NFTs or crypto assets before you can play the game. Unlike traditional game studios with centralized control over game updates, some GameFi projects allow the community to participate in the game's decision-making process. They can propose and vote for future updates via governance DAOs. GameFi applied in the Metaverse led to the concept of blockchain-based Metaverse platforms. Players can purchase digital pieces of land and develop them to generate revenue. For instance, they can charge other players visiting their land, earn token rewards by hosting content and events, or rent their land to other players. It's easy to see how GameFi attracts gamers by combining entertainment with financial incentives. With the growing popularity of blockchain games, we will most likely see an increasing number of companies building new, exciting GameFi products. Congratulations on completing this course on Web3 and the Metaverse, two mega trends that will reshape our future. Advance your knowledge for the decentralized world of tomorrow with our future courses. We will give you an introduction to blockchain technology. By the end of this course, you should know how a blockchain works at a high level, its use cases, and limitations. Let's dive in. At its core, a blockchain is a special type of database, sometimes referred to as a distributed ledger. Blockchains are one of the most common types of distributed ledger technology systems, so both terms are often used interchangeably. Keep in mind, however, that not all distributed ledger technology systems are blockchains. A blockchain stores information, just like a spreadsheet, but the information is subject to special rules. The rules are: 1. Data can be added. 2. Data cannot be removed or modified. 3. Each piece of data must point back to the previous piece. A block is a bundle of information that follows a specific format. New data can only be added to a blockchain as part of a block. So, the collection of blocks is what makes up the blockchain database. But one thing that makes blockchains unique is the fact that each block is built on top of the last one. Every individual block has a bit of information that references the block that came immediately before it. So, how are blocks connected in practice? To answer this question, we need to discuss the concept of hashing. Hashing is the process of using input data of any size to create a fixed size string, which is also called the output. And this is done through mathematical operations known as hash functions. We can use all sorts of input with variable sizes such as text, images, and videos, but the output, or the hash, will always have a predictable length. The length of the hash depends on the hashing algorithm being used. In other words, hashing consists of taking data of any size and passing it through a function that produces a fixed size hash. In blockchain systems, each block has its own hash that functions as a unique identifier. And every time a new block is created, its hash has to be produced based on the hash of the previous block. So the short answer to our question is, blocks are connected through hashes. Note that each block hash is unique because the odds of finding two pieces of data that produce the exact same hash are virtually impossible. In cryptography, we call this a hash collision. It describes the situation in which two different inputs produce the same hash as output. Therefore, being resistant to hash collisions is what prevents blockchain data from being tampered with. Why is a tamper-proof database like the blockchain useful? In a regular database, modifying or copying data is a straightforward process. However, that presents a problem. How do we store important data in a way that everyone can rely on? So far, the solution has been to trust the entities that store the data. Still, that trust can be misplaced and abused. The great benefit of blockchain is that there's no central authority that everyone needs to trust for the system to work. This means that a blockchain can act as a single source of truth in the digital world. It allows a network of users to agree on what the database contains and to synchronize any new updates. The peer-to-peer architecture of blockchains is made of a distributed network of users, each having equal rights. Updates don't need to go through a central coordinator. Every user on this network downloads blocks from others in order to create their own copy of the database. For all these reasons, we may describe blockchain as a trustless system. What are the implications of a distributed network which revolves around a single source of truth? It means security and redundancy. A blockchain can have tens of thousands of users, each storing their own copy and talking with peers. Even if many go offline, the network will continue to function. It also means immutability. Once a block is added to the blockchain, it can be considered permanent. It means trustlessness and transparency. You don't need to trust anyone. And since everyone has a copy of the blockchain, they can see and verify all of the data it holds. Next, we will review the history of blockchain technology. Who invented blockchain? The idea behind blockchain technology was described as early as 1991 by research scientists Stuart Haber and W. Scott Stornetta. The two introduced a computationally practical solution for timestamping digital documents, so that they cannot be backdated or tampered with. The system used a cryptographically secured chain of blocks to store the time-stamped documents. In 1992, Merkle trees were incorporated into the design, making it more efficient by allowing several documents to be collected into one block. However, this technology went unused and the patent lapsed in 2004, 4 years before the inception of Bitcoin. In 2004, computer scientist and cryptographic activist Hal Finney introduced a system called RPOW, or Reusable Proof of Work, to solve the so-called double spending problem. Double spending is a potential problem in a digital cash system, where a cryptocurrency or any digital asset can be copied and used more than once, like pirated movies or music. Finney's RPOW system solved this problem by keeping the ownership of tokens registered on a trusted server that was designed to allow users anywhere in the world to verify its correctness and integrity in real time. RPOW can be considered an early prototype and a significant early step in the history of cryptocurrencies. Then, in late 2008, a white paper introduced a decentralized peer-to-peer electronic cash system called Bitcoin. The white paper was posted to a cryptography mailing list by a person or group using the pseudonym Satoshi Nakamoto. Bitcoin solves the double spending problem with a decentralized peer-to-peer protocol for tracking and verifying transactions. In short, Bitcoins are mined for a reward using the proof-of-work mechanism by individual miners, and then verified by the decentralized nodes in the network. On the 3rd of January 2009, Bitcoin came to existence when the first Bitcoin block was mined by Satoshi Nakamoto, who received a reward of 50 Bitcoins. The first recipient of Bitcoin was Hal Finney. He received 10 Bitcoins from Satoshi Nakamoto in the world's first Bitcoin transaction on 12th of January 2009. Then, in 2013, Vitalik Buterin, a programmer and a co-founder of the Bitcoin magazine, stated that Bitcoin needed a scripting language for building decentralized applications. He started the development of a new blockchain-based distributed computing platform called Ethereum that featured a scripting functionality called smart contracts. Smart contracts are programs or scripts that are stored, deployed, and executed on the Ethereum blockchain. They can be used to make a transaction if certain conditions are met, for example. Developers are also able to create and publish applications that run on the Ethereum blockchain. These applications are usually referred to as decentralized applications, or DApps, and there are already many DApps running on the Ethereum blockchain. The Ethereum blockchain builds on the decentralized and distributed architecture of Bitcoin. But by introducing smart contracts, which support an ecosystem of DApps, Ethereum expands beyond Bitcoin's core functionality as a payment platform. Ethereum has also given rise to other innovations, including decentralized finance or DeFi applications. Beyond the Bitcoin and Ethereum blockchains, there have been other innovations, such as alternative consensus mechanisms to the proof-of-work mechanisms used by Bitcoin and Ethereum networks. Today, blockchain technology is gaining a lot of mainstream attention, and its application is no longer limited to cryptocurrencies. Blockchain is used in a wide range of applications and industries, including healthcare, supply chain, gaming, digital identity, governance, and energy. In the next module, we will look into how blockchain works in more detail. The interesting part of blockchain technology isn't so much the database itself, but rather how the same database can be used by a network of strangers who don't trust each other. Without a central authority, this isn't an easy task. To achieve it, blockchain networks rely heavily on a mix of game theory and cryptography. In this module, we're going to take a deeper dive into those mechanisms. It wouldn't make much sense for your bank to have a public document detailing every transaction between users. Due to their centralized client-server model, they can validate transactions in private. A blockchain, though, is a public database. Everyone needs to be able to look at a transaction and say with certainty that it's valid. If someone adds data that says, Alice gives 50,000 coins to Bob, how can we tell that Alice actually authorized the transaction? Who's to say that Bob didn't just add it himself? Maybe you could have some kind of a password system, but that gives you two options. Either you use a centralized entity to check them, or Alice publishes her password for every transaction. The former doesn't work in a decentralized setting. You might as well just use a regular database. The latter doesn't work because everyone would know Alice's password. After her first transaction, anyone can make a transaction masquerading as her. To get around this, we use some cryptography, which involves the transformation of data for the purposes of secure communication. Even if an adversary intercepts a message from Alice to Bob, they won't be able to decipher it without a special key. Something like the Vignere cipher is what we call symmetric encryption. For example, we can use the key HODL to transform our plain text into ciphertext. It's not impossible, but it'll be time-consuming for an adversary to figure out what the plain text is without knowing the key. However, if we give someone the key we use to encrypt the message, they can use it to decrypt it. That's why it's symmetric. The same key is used to encrypt and decrypt. The thing we're interested in here is public key cryptography, in which you use a pair of keys, a private key that you keep secret, and a public key that you can share. Both keys are linked, so by using your private key, you can easily generate the corresponding public key. But this only goes one way. It's virtually impossible for someone to take a public key and reverse engineer it to get the private key. Therefore, there's no security risk to you sharing the public key. In fact, you need to share it to make transactions. Private key holders can write a message and digitally sign it using their private key. By comparing a public key with a signature, you can safely assume that the person who owns the private key has written the message. This is an important building block in blockchain systems. The private key acts like a password, or rather an identity, generated mathematically. By using your private key to sign a message, you certify that you're not authorizing an action. That's why you should never share it. Anyone who knows your private key can produce a valid signature to spend your money or otherwise impersonate you. In a nutshell, blocks are made up of messages that say something like, I, Alice, pay 50,000 coins to Bob, and here is my signature to prove I authorized this transaction. That message gets passed around the peer-to-peer network as users check that the signature matches Alice's public key. If it doesn't, they'll ignore it and the transaction won't get validated. So, we figured out how to stop people from spending Alice's funds. What we haven't figured out is how to prevent Alice from spending the same funds twice. How do we decide which transaction to include in the blockchain? Who decides? How do we reach a consensus decision in a distributed system? We will answer these questions in the next module. Coordinating entities in a distributed system has been a long-standing problem in computing. Without a central coordinator calling the shots, how do you find a way to get everyone on the same page? This is the Byzantine general's problem, in which, in order to avoid catastrophic failure of a system, the system's actors must communicate with each other and agree on a single truth. Some of these actors may be unreliable. This dilemma is very applicable in computer science. Systems that can overcome the problem are said to be Byzantine fault-tolerant. In blockchains, the Byzantine general's problem is mitigated by allowing all users on the network to validate the information. In the interest of precision, we'll stop referring to users as users and call them nodes instead. In the decentralized environment we're trying to create, nodes don't, or at least shouldn't, trust their peers. You never know which one could turn malicious, or whether they're unknowingly passing you false information. To combat the spread of false information, we use a blockchain to sequence the messages as they appear. If nodes want to submit a message, which in our case is a block, then they need to put in some work to prove that they're serious. This is the logic behind proof of work, a type of consensus mechanism allowing nodes to coordinate in a distributed setting. Such mechanisms ensure that all agents in the system can agree on a single truth, even if some agents fail. In proof of work, hashing is used, as we've discussed before. What we didn't mention is that there's a specific hash that nodes need to find. They hash the contents of the block they want to broadcast to the network and hope the hash matches the parameters set out by the blockchain. Remember that our block must also include the hash of the previous block, so it can only be created after the most recent one. In proof-of-work systems, it's often incredibly difficult to calculate a valid hash. Nodes use large amounts of computational power and electricity to do this. But here's the thing. Once they do find one, they send the block around the network. Anyone can easily check that it's valid and hasn't been edited, because they only need to hash it once to see whether it produces a correct hash. They'll check all of the information inside the block too, whether it was built on a previous block and whether the transactions are authentic. This dynamic, expensive to produce, cheap to verify, is some of the game theory that makes blockchain systems viable. You'll be out of pocket if you produce an invalid block, as the other nodes will immediately reject it. Proof of work was the first consensus mechanism to surface and remains important. This process of using proof of work to solve a block is called mining, and nodes that participate in mining are called miners. We call them miners because they're working to extract a reward from the protocol. Despite proof of work's strength for preventing system abuses with a high level of security, it has some limitations. For one thing, when the network becomes larger, it requires expensive equipment and high energy usage. Therefore, alternative consensus mechanisms were introduced to mitigate these limitations. A prominent alternative consensus mechanism is called proof of stake, which was proposed back in 2011. Proof-of-stake mechanisms use a pseudo-random election process to select validators from a group of nodes. The validators hold and stake the native cryptocurrency of the blockchain in order to validate transactions. Staking refers to the act of validators committing funds to the blockchain network. The locked funds will then act as collateral, meaning malicious validators will most likely lose their stake and be kicked out. On the other hand, honest validators will be rewarded as new blocks are produced. Generally, the more coins are staked, the more likely you get to validate a new block and receive rewards. Beside proof of work and proof of stake, there are other alternative consensus mechanisms. Delegated proof of stake and hybrid POW/POS are two examples. To sum up, consensus mechanisms are critical to allow distributed systems to work together and stay secure, and proof of work and proof of stake are two dominant mechanisms. In this module, we'll discuss the different kinds of nodes, blockchain network structure, and how conflicts are resolved in a permissionless setting. In blockchain systems, not all nodes are the same. Under the broadest definitions, any machine that interacts with the network in some way can be considered a node. So far, when we've talked about nodes, we've been discussing full nodes, nodes that have a full copy of all the blockchain's transactions. When a full node receives a block, it will perform checks on the contents of the block, including the timestamp, hash, and difficulty. Amongst other things, it must verify each of the transactions on whether the inputs have previously been spent, whether the signature matches the public key, whether the sum of the inputs is greater than or equal to the sum of the outputs. If it's satisfied, The node will keep a copy of the block and propagate it to the rest of its peers. A full node is the best way to get an accurate image of the blockchain. Without one, you need to trust a third party to feed you the data you need. But because they download, validate, and store all of that information, they might not appeal to everyone. The Bitcoin blockchain is over 400 gigabytes as of mid-2022. Nodes download and validate blocks at 10-minute intervals. To some, this may be a strain on storage and bandwidth. On the other hand, light nodes are devices that connect to other nodes, but perform limited validation on the data. Because of this, they have lower storage and bandwidth requirements, and can be run on devices such as cell phones or low-end computers. If you use a non-custodial wallet, that's most likely a light node. Instead of downloading full blocks, light nodes download only the block headers, which are much smaller in size. The block header gives you important information such as previous block hash, timestamp, and other metadata. Ultimately, light nodes rely on full nodes to operate. Then, there are mining nodes. Technically, mining nodes are either full nodes or light nodes, but these are a subset of nodes that perform the proof of work necessary to secure the network. For cryptocurrencies like Bitcoin that use proof of work consensus mechanisms, a simple computer isn't enough to perform the hashing operations. Because there's so much competition in mining, specialized machines must be used. Examples include GPUs, as you might find in gaming computers, or purpose-built devices like application-specific integrated circuits. We say that public blockchains are permissionless and anyone can become a node. You might be wondering, with nobody in charge, how can changes be made to the network? In a truly decentralized network, changes can be made with soft forks or hard forks. A hard fork occurs when you want to introduce changes to the software that make older nodes obsolete. The network is effectively fragmented into two parts, one made up of old nodes and one made up of upgraded nodes. The two can't communicate. For all intents and purposes, there are now two networks. Soft forks are upgrades to the network that are backward compatible. Certain upgrades can be added in a way that doesn't interfere with the regular functioning of the network. For instance, a block size reduction. A soft fork might be preferential in scenarios where you don't want to divide users into different camps. In effect, the upgrade is considered opt-in. Certain newer features might be invisible to you, but you can still communicate with the upgraded nodes. Now, we have a general idea of what a blockchain is and how it works, but what can it actually be used for? Let's review some of the important fields where blockchain technology is being utilized. Sending money between different parts of the world can be quite expensive, with middlemen charging hefty fees for what's essentially moving bits around on the internet. How would you react if it suddenly took 3 working days to send an email? While sending money is a more delicate matter than sending an email, the remittance infrastructure is undoubtedly outdated. Sending money via blockchain can be fast and incur low fees. Many countries have or are considering issuing central bank digital currency, also known as CBDC. It's the digital form of a country's fiat currency. This could have a huge impact on the remittance market and the global financial services market. You've probably also heard about blockchain's use cases in the decentralized finance space. The idea of DeFi is to create a more open, inclusive, decentralized, and transparent financial system that runs on top of public blockchain systems. By removing financial intermediaries, DeFi gives people direct control of their assets and permits them to conduct peer-to-peer transactions. Moreover, blockchain technology is quite reliable in storing records with high data integrity, while enabling many different participants to use the same database as a shared source of truth. Supply chains involve many different companies that have to integrate their systems with each other to handle goods from suppliers to consumers, often across borders and through customs. Blockchain technology can make interactions between businesses smoother and more efficient, which ultimately benefits the economy and the consumer. Similarly, storing digital health records is essential for an efficient healthcare system. This delicate data has to be stored and shared with exceptionally high security standards. Blockchain technology can make digital health records more secure and private. Blockchain has many other use cases in industries such as gaming, charity, and energy. It also provides an alternative governance mechanism for organizations. But ultimately, it's still a developing ecosystem, and more transformative applications may be uncovered in the future. Blockchain technology does have some limitations, however. Blockchain's immutability comes with a downside when it's necessary to make changes. There aren't many good solutions to this problem, and this can hinder the evolution of a blockchain system. Blockchains use public key cryptography to secure the ownership of value in the system. If a user loses their keys, the value that those keys grant access to becomes inaccessible forever. Blockchains, and more specifically, Bitcoin, has been a target of criticism over its high energy consumption. Another limitation to consider is storage. As the size of the blockchain grows, the entry barrier could become higher. What follows is that there would be fewer machines in the distributed system, which may have a detrimental effect. The network's resilience to attacks and exploits could dwindle. Speaking of attacks, one of the most discussed is the 51% attack. If malicious actors could amass more than 50% of the mining power, the attackers would be able to undermine some of the fundamental workings of the blockchain. In reality, though, such an attack would be incredibly costly and difficult to pull off.